Good morning. Welcome. It is 6 a.m., half an hour before the market opens on Friday, February 9th. So we had our first full week of trading and it's been positive. It's been up. Nothing happened too much yesterday. We were mostly sideways trading. So unless we've got some weird news happening this morning, there shouldn't be really anything all that exciting. We can see that in the overnight session, we just kept on going sideways. In the morning session, we're slightly up. I wouldn't be too excited about anything here. Let's take a look at our futures. Oh, futures. Okay, futures were up for sure. It's about quarter of a percentage point in the S&P 500, about 35 basis points on the NASDAQ, and 20 basis points. So this is basically like yesterday, except maybe flipped around. Yesterday was kind of down. So we had the NASDAQ that was kind of on the edge of significance, and the S&P wasn't too far behind, and then the Dow was lagging. Now we've got the exact same situation, except flipped around. Yesterday we traded nowhere, but today maybe we're going to trade nowhere. We are on a Friday. We tend to wind down our activities. We don't want to take risk over the weekend, or we will hedge ourselves over the weekend. And there's no major news that we know of coming out today. Let me just confirm that on Econoday. Yeah, nothing on here. I started trying to experiment with this other economic data report because Econoday is limiting more and more what you can see. So for example, I can't see into next week. I can't see into last week. So I want to see if I can use a different source to get the information. For example, if I want to see next week, I can see that there's nothing really going on Monday. Tuesday, we have inflation and CPI. So we might not get any activity or a lot of movement until Tuesday because this could change things. This report could help us get a better clue as to whether or not there's going to be a rate cut in May. So money will start to get allocated after that, or we'll get a better idea of the direction of the markets after this report. So I wouldn't be too surprised if we trade sideways today and maybe even Monday. And unless we get some major news over the weekend, the only thing we really have going on is earnings, and there's not that much left. Well, I guess there is. Let me rephrase that. This month, if I take a look at when earnings are showing up, we can see that there's not too much on the 29th. There's not too much on the 27th. There's a very small handful on the 26th, very few on the 23rd, and then there we start to see a whole bunch on the 22nd, 21st, 20th. So what that tells me is that earnings starts to wind down at the end of this month. In that last week, there's not too much going on, but before that, there is a whole lot going on. Basically, in the next 1 week, 1 to 2 weeks, 1 to 1.5 weeks. So earnings is going to be behind us by then. So what I can expect is that I know the major market cap stocks have already reported, and so there's not that much market cap left. So if I were just to guess right now, just based on what we've looked at, we're probably 60 to 70% through in terms of market cap, maybe a little bit higher than that. I would have to look in official reports or calculate in order to get a more accurate number. But the bulk of earnings is behind us by now, so that's not going to play a huge role in the markets as well. So basically, we have a market that is just trading based on, there's no stimulus to it. If there's no stimulus to it, then it's just going to continue the way it's been going, which is this nice, slow, steady movement upwards. And so we can expect that for the next 1 to 2 weeks, as we've been saying for a while now. So we've got this nice uptrend. We should still be leaning our portfolios upwards. We should still be hedging on the way down because that could break at any moment. And what we're looking for is the sector rotation. When does money steadily and reliably from day to day, multiple days in a row, move away from the tech focus and the discretionary focus into more safe and defensive sectors? And when we see that become more consistent, we'll know that we're topping out, that there's not too much further that the markets can go up, and then something will break or crack, and then we'll start going into that pullback that we've been anticipating. Even if it's not the pullback we've been anticipating, even if it's just the pullback to the trend line, then we would still see that pattern play out, unless it's a very short one. If it's a like 1 or 2 day one, then we wouldn't see that play out. But if it's going to be a several day like this one, we'd expect that we would have seen that rotation, or this one, we would have seen that rotation. So that's what we're going to look for, because that indicates a deeper pullback or the start of a correction. So let's take a look now at where our sectors are relative to each other. So on a long-term basis, we've still got tech at the top. If I look at only the 12-month, tech at top. Interesting that we've got this home builder. Home builders are on top as well. Interesting. Half a year, same thing, exact same sectors. 3 months, pretty much the exact same thing. We just have retail up here as well, which is a consumer discretionary. 2 months, same thing. 1 month, same thing. 2 weeks, consumer discretionary, healthcare, industrials. So we're starting to see a shift in the last 2 weeks. Let's see if it's maintained in the 2 months. And was that on 2 weeks or 2 months? It was on 2 weeks. So let's see if that held in the last week. And not really. We started to shift back into risk in the last week. And that's what I was talking about. We need that consistency. Just because we flipped for a few days a couple weeks ago doesn't mean that the money continued to come in. So yesterday we had home builders, small caps. That's interesting. Let's take a look at small caps in just a moment. Retail, semiconductors, energies, real estates, consumer discretion. So not much of a change. Even though the tech sectors are further down, the defensive sectors didn't come up. But what came up was retail, which is basically consumer discretionary, energy, which at this point isn't too correlated to the markets, and then the small caps. So small caps is an interesting change in development. So let's take a look at that. So in the S&P, we were flat. In the NASDAQ, we were flat. In the Dow, we were flat. In IWM, we went up 1.52%. But that's normal movement for at least recently in the IWM. So this was down 2.4, up 1.3, down 0.5, down 1.27, up 0.9, down 0.23, up 1.5. So it's not out of range. It's not like a whole bunch of money rushed in. That's normal movement for this small cap stocks recently. So I want to look at zoom out and look at a broader picture. And what happened was we just bounced off of this lower line right here. So this was supply resistance. We drew these lines at least maybe a year ago. And this was an important level that we identified. If it broke out and went up consistently, then we would identify this level. If it breaks out and then holds and goes up, then we would start to see a rally in the small cap stocks. And it could be the beginning of a bull market, a true, healthy, sustained bull market. Right now, we're just bouncing in between these two lines. It's good news that we didn't fall through it, but this is just chopping sideways so far. So it's not time to get super enthusiastic net quite yet. And if we look at the ARK fund, which is even riskier small cap stocks, then we can see that we're still not there yet. Let me draw another line over here. Okay, so we're just, looks like we might enter a channel and go sideways. And then we'll want to see it break out of that channel and move upwards. It's good that we didn't break down though. Let's look at bonds. What did we do in bonds yesterday? So we came down yesterday into kind of this no man's land below the lows that we've seen for a while. So that's significant. It looks like we're floating up higher, but if we don't get conviction, we'll just be in the same range, or we'll going to creep lower. Since we're expecting a sideways movement in the equities markets, it's not too unreasonable to believe that we're going to get the same thing in TLT, because I'm pretty sure, if I saw correctly, and nothing going on today, but on Monday, yeah, there's a bunch of T-bill auctions. So that could give us a little bit of movement in TLT on Monday, but today I'm not expecting too much out of it. So really, it feels like, I could totally be wrong, but it feels like we're going into a kind of quiet Friday. There's not too much going on, and the markets might just drift a little bit. Unless we see significant directional movement, and what I mean by that is what would be significant. These bars have been small. If I get anything larger than this range right here, which was open to close, it was only 2 points. I would want a bar more like this, about 5 points. If we get a 4 or 5 point movement, I would consider that significant. If we get a 2 point movement, a 1 point movement, a 0 point movement, 0.22, and like we did yesterday, then we're not going to read anything into it other than we're continuing to chop sideways. And without stimulus, we're probably going to continue to chop sideways. And the only stimulus that we see on the horizon is potentially that CPI report on Tuesday. So it might be a quiet Friday, a potentially quiet Monday, and then we'll see on Tuesday. That's what it's looking like so far. That could change at any moment, but as of this second, looking at the markets, that's what we would anticipate. If you anticipate, we're not going to trade based on our anticipation, but we will be emotionally prepared to just for a boring trading day. That's basically what we're doing right here. So nothing else really to look at. Oh, we could check, well, we already checked on our Allstate and IVC yesterday after the market. So obviously that hasn't changed. We can take a peek pre-market. I don't know if they trade pre-market. No, Allstate doesn't. IVZ sort of does. So it looks like IVZ might open higher. So these are often head fakes though, especially the ones with very little data pre-market. So the S&P basically trades every single minute pre-market. But this one only traded once at 5:42, so half an hour ago. So this isn't going to be necessarily indicative of where IVZ opens. So don't get tripped up. Sometimes we look at something like Yahoo Finance, or if I open up Yahoo Finance on my phone right now, it's easy if I take a shot right here. If I just look, it says, oh, pre-market, this one is up 0.3% or up 2%. Or for example, it's telling me that it's down, or sorry, up 2.1%. Well, if U has been trading not every minute, but pretty densely, so that might be reliable information as to where it's going to open. But IVZ, it only traded once. So that's unreliable information. So I can't just look at a screenshot like on my phone that says it's up a certain percent and expect that it's actually going to open there and stay there or be indicative of direction. I need to know how frequently it was traded in the pre-market to decide how reliable this pre-market information is. So don't get too excited about something like this, and just wait and see. This is why we, in general, unless you are a fund manager that has additions and distributions, most institutions aren't really trading that much in the first half hour to hour. So if I'm a fund where there's additions and withdrawals, then I have to trade in order to get my cash managed. But if I'm not, if I'm, for example, a retirement fund and I don't get additions into my fund except every 2 weeks or every month, then most of the days I'm sitting. I'm not trading that crazy volatility in the first hour. What I'm doing is most of my activities at the end. So institutional money is mostly traded at the end of the day, not at the beginning of the day. At the beginning of the day, what you're seeing is mostly retail traders who are emotionally reacting to overnight news or futures or pre-market trading action or whatever it is. And most institutions, unless they're forced to, they won't be trading in that first half hour to hour. So generally, that's my advice too. But just wait and see, because that first half hour, an hour is going to be volatile and not necessarily indicative of any direction. And then after that hour, you can start to see where institutions start putting their money to work and what direction we might be headed. Okay, so looks like we might be in for a quiet Friday, and we'll see. And then I will see you guys in the aftermarket.